On that Canadian dollar story, let's get to our top story. We're a little more than 24 hours away from a new federal budget, and we've got an ominous call on the state of the Canadian economy. David Wolf is portfolio manager at Fidelity Investments, also former advisor to the governor of the Bank of Canada, believing we might already be in a recession, and importantly, the Canadian dollar could tumble to as low as 62 cents US. Did you mean to say that? That's my first question.
So let me say a couple of things before we get into the why and the where and the what. First, so Fidelity does not have a house view on this. So I'm speaking for myself as a portfolio manager responsible for multi-asset class funds in Canada. And second, you mentioned the word ominous a couple of times in the introduction. And I don't think of this as an ominous projection. I think of it more as the Canadian economy has some pretty significant headwinds at this point. And a weakening of the currency would be part of the solution, in a sense, in dealing with the imbalances that had built up in the economy.
But I guess what's ominous about it is the magnitude of the decline. Perhaps you wouldn't find people that would argue against you about this potent cocktail of high household debt and slowing global growth. But when you're talking about the Canadian dollar trading possibly to record low territory, that seems like a high threshold, especially when you consider even during the depths of the financial crisis, we didn't get there.
Right. So it sounds extreme, and it even sounds extreme to some degree to my ears. So let me give you a little bit more context and tell you why I don't think it's actually that extreme of a projection. So if you go back 6 or 7 years ago, say 2011, you really had the stars very much aligned for the Canadian dollar. So we were the strongest economy coming out of the global recession. If you remember, rates had already lifted off in Canada, even in an environment where the U.S. Fed was thinking about more quantitative easing. Oil was at $100, so you had all the stars aligned for a Canadian dollar trading well above its longer-term fair value. You remember slightly above parity. And so I think what we're looking at right now going forward is the flip side of that, the stars aligning kind of in the other direction. So the Canadian economy was very weak in the fourth quarter. It looks like the household sector, which has been subject to great imbalances, as you know, for quite some time, is rolling over. It actually detracted from growth, consumer spending and housing for the first time since the first quarter of 2009. The export sector and capital investment are not picking up the slack the way that we might have hoped. And oil is $50, not $100. So if you saw the Canadian dollar trade 25% above its fair value when everything was going great, it's not really such a stretch to say that it might be trading 25% below its longer-term fair value under these circumstances, and that gets you right around those 62-cent lows from 2002.
Now, when the Bank of Canada kind of originally stepped in to cut rates and we saw the Canadian dollar come off, you know, I'm thinking about the early days of Stephen Poloz, where it was, whether it was overt or not, it was a policy that effectively lowered the Canadian dollar. There was a moment where there was a thinking that that was happening too quickly. And instead of being stimulative to the economy, that was in fact injecting more uncertainty because people stepped back and said, whoa, the Canadian dollar is falling this much. Maybe there's a bigger problem there, and I don't necessarily want to invest in that environment. Wouldn't that be the same sort of situation if in fact your scenario comes true?
Well, so let me mention a couple of things about that. First of all, in 2015, which is what you're referring to, it was a bit of a scary time for Canada, and we did have, at least as some people would put it, a technical recession with 2 quarters of negative growth. And you remember the Canadian dollar did get down below 70 cents. And in a sense, it was too soon. One thing that I'll remind you of, I think you and I were talking, it would have been a little bit more than 4 years ago. So I came on the program in January of 2015 and said, listen, we've got these headwinds here. We're worried about this. And 2 days later, the bank cut rates and the Canadian dollar was down, as you mentioned, more than 10% over the subsequent period. I think what's happened now is not only do you have the pressure on commodity prices and a slowing global backdrop, but partly because of the interest rate cuts that we saw 4 years ago, these household imbalances have only gotten bigger. And so the potential downside from housing and consumer spending rolling over is quite a bit larger than it was previously.
Well, when you look at how the markets are trading, the rebound that we've seen in oil prices, the assets, the sectors within both the TSX and the S&P 500 that have been moving higher, it is not the defensives, it is not the sectors that are insulated from an economic downturn. It are those that are very much in the center of economic activity, whether it's semiconductors, whether it's the energy stocks themselves. Does that not indicate that the equity markets are looking through that slowdown because they're pricing in a future environment? Or are you saying that they've got it completely wrong, and if you're positioned that way, that's a very dangerous place to be?
Well, clearly, global equity markets are reflecting a more constructive view of the global economy than, say, 3 months ago. And that's all well and good, and I think they're to some degree mapping that to a cyclical economy like Canada's. One of the challenges is that there are some pretty idiosyncratic risks in Canada, many related to these housing and consumer imbalances that I've talked about. And let me also say further, it's not like I'm looking for the Canadian dollar to be 62 cents tomorrow or next week or even next year.
What is the timeline?
The timeline is more thinking about what has to happen through the cycle. And that's how we tend to do things, and we're longer-term investors. So I was a forecaster for many years, an economist for many years, as you know. I know how silly it is to try to put a level and a time on these things. But our general view is the currency is likely to get weaker, and it needs to help rebalance the economy. And at some point in the next cycle, again, don't know exactly when that is, that we're likely to see a test of those January 2002 lows.
Just quickly, we only have about 30 seconds left. What would the Bank of Canada think if you brought that this assessment to their doorstep?
Well, so the bank has talked about the soft patch right now as something of a detour. And I think it is a detour from going home. What I worry about is if it's a detour where you get off the highway, you start going on country roads, you end up way off of where you started, and you're wondering how you get back on that path back home. So they understand it's a detour. What I'm saying is I think the detour may be a bit more significant than some may believe.
David, thank you so much for joining us with your perspective.
Thank you.
That's David Wolf, Portfolio Manager in the Global Asset Allocation Group at Fidelity.